This conference will now be recorded.
Good afternoon, everyone. Thank you for joining me for this live pop-up trading session. Let's jump in and talk about the markets a little bit, what's going on. We have the ES, which is the S&P 500, up quite a bit this afternoon, 0.5%. The Nasdaq is finally underperforming, but obviously you know that this is all-time highs. It's up quite a bit. It's up like 1,000 points more than it was when it hit the high before COVID-19. The S&P 500 ES hasn't hit that high yet since February, but it's on its way. The Dow hasn't as well, and the Russell has been the lagger, so obviously it hasn't. And even if it did hit its February high, that wouldn't be the high. It was actually the Russell hit its high in 2018 and hasn't returned to that level yet, which is, in my opinion, what the market should be at, but obviously that's not the case. So let's just take a look at this. This is the RTY, and we go to a 3-year chart here. Click on the 3-year weekly, and you'll see that the high for the Russell was actually in 2018 at 1746. So that February high wasn't the high. Very interesting how the Russell has underperformed for, darn near 2 years. But in my opinion, it's more close to what the market should be. But that's just one person's opinion. Obviously, the market is giving another opinion, and that's that the Nasdaq is the leader of the pack now, and whatever the Nasdaq dictates, that's what the market's going to do. At least for now. I like to tell the story of that the Nasdaq was doing this kind of stuff in the late 90s, and then eventually when the music stopped, the Nasdaq went down 78%, basically 80% from its highs, and it took over a decade for it to get back to where it was. So it was like a lost decade. Things like Microsoft, that's been going up almost every day. It's down today, but fraudulently down. That was a dead stock for, it seemed like 15 years. It didn't. Microsoft didn't become a sexy stock again until Steve Ballmer, the previous CEO, left, and then next thing you know, it was go again for this stock. Not that they're not doing some good things. I like Office 65, which is now Microsoft 365. They got a cloud business and things like that, but it's still, to me, crazy how much we're up. But you guys are hearing me say that every day almost. I'm sounding like a parrot here. But what I wanted to do for this live trading session is, kind of give my opinion, and then look for some trade ideas. Looking at these positions that we have in this account right now, we have this ES trade that we did, I believe, on Tuesday, which was a synthetic iron condor. We sold the ES at these strikes here on the call side, and that's a little down since we opened it. It's pretty flat. It's only down $9, basically just under $9. And then the put side that we did it on the RTY, and that is this one here, and we did it in 30 days. So it's only been two days since we put the trade on, and that RTY is up about $8. So on this trade, the synthetic type of iron condor, we are up, flat on the trade so far with 28 days to go. So basically just a 15-day type of trade, trying to see how much this premium can come out of those positions within the next 15 days. We did it that way so that if the market goes down a lot, we can easily adjust the RTY. If it goes up a lot, we can easily adjust this ES by adding the other side. So instead of starting off with an iron condor at that point, last week we put on this gold position, and we were down on it every day. We just broke even right now, as you can see, because today the last few days premiums be coming out of this gold position. So You just have to let time work for you, trade small and let time work for you. This Nasdaq position I'm trying to get out of is 7 days ago, but the Nasdaq is up there every day. You can see this is over 1,600 points away. My closest short strike in this 7 days ago still won't get me allow me to get filled. It's a few other people that have some puts on, and the Nasdaq is experiencing the same thing. So I'm just going to let this play out a little bit. Maybe they'll fill me a little bit later today. But with that said, I'm looking for some new trades. So I'm looking at what we talk about in lesson 9. Of course, I'm kind of scanning through the watch list here and trying to see, okay, what kind of trades can I put on? I'm going to first see what's up big, 2%, or what down more than 2% on the watch list. And I'm looking across the board here, and I'm looking at, I see that corn. If we're looking at this Tastyworks watch list, I'm looking at corn. It's down about 3%, and natural gas is up about 2%, or a little over 2.5%. So those are two of the things that's popping off the chart here. If I go to this Thinkorswim platform and try to look at some stuff there as well, it's pretty much the same. I was just getting a different view of it. If I put in the natural gas, that's gold that I just typed in. If I put in the natural gas and see that, okay, it's been going up for maybe about 2 weeks here. For the most part, this trend on natural gas has been going up. But to me, natural gas has a long-term, it's been about 2 years as well, like that Russell I was talking about earlier, of going down for the most part, or just staying in this range here. So I'm not ready to sell any calls on natural gas. I would actually look to sell some put spreads on that still. You know that on Tuesday we were looking to sell a naked put on natural gas, but unfortunately didn't get filled, and it's up a little bit. So I'm going to wait until that actually comes down again, if it does, and then we'll execute that type of trade. Looking at corn, that's down about 3% this afternoon. Taking a look here, and corn obviously was on a pretty downtrend as well, and then it's just flat for quite a bit. It shot up in the last week or two. So this is some ambiguity on what it's going to do. Is it going to continue to go higher, or is it going to go back and test its 50-day moving average, which is this bluish line here, this bluish line there. This gold line is the 200-day moving average. So it looked like it touched its 200-day moving average, as you can see here, and then retreated back. So it could be going based on the day's move. It could be going back to its 50-day moving average. Obviously, I'm not a chartist. I just show these charts just to see where something is going, and then I have my assumption, right? I don't know if something's going to go down or go up or whatever. I just place my bet on the assumption, but I'm not betting directionally. I'm trying to see if I'm placing a bet, and if I'm wrong, I can still be right based on how we trade these options. All right, so let's look at this. Let's look at this corn first to see if it's a position we can do in this corn. Trade here. So I'm clicking here, looking at the 42 days here out of these expiration periods that we have. And corn is usually, the risk is usually to the upside, and the expected move right now is about 22. So let's just say 40, about 362 is the upside. So if I'm looking to, let's just say, sell a call spread in this, let's look at the 324, the 365 is for the one expected move, or one-time expected move, is the 24 delta. If I go 2 times that expected move, it's more around the 385. So that's about a 12 delta. So if I look at that and look to, let's say I decide to do a 15-point wide spread, let's see what that looks like. All right, so getting $38 for one contract, as you can see down over here. Max loss is 712, and if I do 2 contracts, max loss is going to be potentially a little over 1,400 is still not very good on the buying, on the actual monies that I'm receiving on this trade. So if I wanted to, I could see if I could bring it up a little and go to the 14 delta trade between the 15 and the as high as the 15 delta here. If I do that, that is same type of trade, 15 points wide. If I hit review 2 contracts, see if I get 93, I'm not, or at least $100. I'm not getting at least 100 on the trade yet. So let's see if I widen it a little bit like that. And now still max loss is still under 2,000, potentially max loss. I'm just looking at that just in case current shoots up, how much would my buying power change? So in this case, it's really insignificant to start off with though. So if I hit review, that's 105 to start with. So I actually like this. We're gonna send this, we're gonna lock it there and see if we can get filled with a 14-day trade. Let's look once again at the chart and see where natural gas has been. All right, so we're at the 180, is about 20 points. So it's still not too bad. Let me go back over here. This is the max I would do point wise, and it's been down. I'm selling it more, thinking it's not going to go too much more higher, too much high. So I'm going to actually do that there, and then I wasn't going to do the natural gas. Let's look at oil here, because this oil, if we look at the chart here, I haven't put on an oil trade in a while since the brokerage firms kind of forced you to get out of the call side, if you can remember, if you were trading that. All right, so this is oil. It hit its high back in February when everything was going up. It went down when the market went down. It's actually been going up since it hit its lows. It's been going up quite a bit, but it's been a little flat here. I'm trying to go indirectly short the market, so looking to sell a call spread in the CL, but let's see how the call spread looks, right? So looking at the expected move here, it is 4. So if I want to go double the expected move, that's going to be about 8. So about 48 is the strike I would start at here, trading between no higher than the 15 delta here. So at 48, I'm looking to do I can do a 1 point wide spread there, but that's not giving me very much capital there. The buying power is fine, the max loss is fine, but if I move it to a 2 point wide spread on here, the buying power is still okay, but the profit that they're giving me before fees and commissions it's not 100. I'm looking for at least $100. That's only 80, and that's before fees and commissions. So as you know, it's going to be lower than that. So in this case, looking at that chart, right? This is an argument, and I've been trying to just play one side recently, but it's always an argument for an iron condor from time to time, right? So this might be a good iron condor type of strategy. So let's look at it and see if we can optimize this to be a pretty solid trade. So that's a 2 point wide on the call side. Let's look at the put side here, and let's go down 8 points. So let's look for the 32, at least the 32, right? So 2 times expected move on both sides. So if I sell this one here, which is the 32, and buy the 30, I'm giving myself a chance to easily roll. By the way, in concert on this Tastyworks platform, we have the problem with the options on futures on rolling, so you have to set it up to trade correctly when you first do it. So now you see this trade. This is actually pretty good, right? So you're getting 210 before fees and commissions. Your max loss is under 1,800. Your buying power is only 532. So if we hit review, that's pretty good, right? So if you want to reduce your risk and kind of skew it to one side, let's say I'm trying to get some indirectly go short the market here, right? So I'm at the 11 delta there and 11 delta here. So this is pretty neutral type of iron condor that's sitting in the middle here. As you can see on this chart right here, it's basically in the middle. So I don't want to do that. Let's say I want to skew this to the downside. So I'll move this a little bit, right? So I move this down. Let's say I moved it down to the 9. I'm still getting a decent amount. Let's try to see what happens. I move this to the 8 delta. So I move this to the 8 delta. I'm still getting a decent amount of premium on the put side. Buying power is 1830. So that's not bad. Since they have half strikes here, as you can see, they got a bunch of half strikes. I could decide to change this to a shorter width on the put side, but that wouldn't change my max loss potential because the call side is still 2 points wide. So I'm trying to keep that skewed a little bit. Or if I want to skew it a little bit more, I can go that way. I can go that direction, right? Make this 1 point wide. But you can see it didn't change the max loss potential and didn't change the buying power really. But I will be getting 100 over more than 100 if I can get filled at that. So this is obviously going to give me, this can be indirectly shorting the market if oil continues to go the way the market has been going. But I'm going to move that back out a little bit, and I'm going to do it like this. And I like this trade, and I'm going to lock it in at 17, and we're going to see, just in case, I'm going to send it at 18 first, just to see if they are playing the game today on these. And so I sent the 18. We got 2 things working. We haven't got filled on anything. So now we're going to break this down we're going to replace this on the oil, put it back to 17, see if they'll fill us on that. And then we got filled right away in oil. So as you know, we received over 100. So we're going to take about $30 and we're going to hedge. So when you're hedging oil, you can hedge in the USO. And so what I'm going to do this time is a little different type of hedge that you probably haven't seen me do before. So normally when we're hedging, we're going to hedge in the USO, and we were that trade that we just did was 38 days to expiration. So if we go into the USO here, and we're going to normally we will sell a put spread or a broken wing butterfly or something like that to hedge at the 30 delta. So it's 38 days. It don't have a 38. So if I go to this 35 and I look for a hedge, I could go to this 30 here and buy a put spread there. That's not going to cost me very much to do that. It's only $11. I can do 2, but it's only a half a point. So let's change that there. So that is still 2, and we're getting a potential max profit of 158 and a max loss. Obviously, you don't care about the loss on a put spread when you're hedging. So this is an option, and let me know which one you would do. Right? This is a two contracts put spread to hedge, and we can also clear this and do a broken wing butterfly. So we can buy at this 30 here, and then let's say sell at this one and buy at this one and sell 2 of those. So this right here is a net debit, and if we did, let's do 4, 4, and then clear this and highlight this one to do 2, and then highlight this one to do 2. All right, so it's basically 2 contracts for the broken wing butterfly. If you look at it, this one's going to cost, this broken wing butterfly, that's not bad, right? So it's only going to cost, about $26 to do, because it's time 2, that 13 there, and it's your max profit is similar to that put spread. I think this is about $20 more, but it has to pin here to get that max profit. But if it goes all the way through, you're still going to make something, because this is a broken wing butterfly hedge. So that is an option. So I showed you the put spread, showed you the broken wing butterfly, but we can also do something that's a little different, right? We can buy a share, right? We can buy a share, and keep in mind, when you buy shares these days, it's no commissions to buy. It's free to buy a share, right? You can buy a share. That's always fun. And you can, or buy a couple shares to be able to hedge a little bit, right? So, and that's, we sold the we sold the call side, so we were kind of skewed to the call side. So what we would do is protect the call side. So if it's going up a lot, if you buy the USO, it's going to help. I was obviously looking at the put side a second ago, so I should have been looking at the call side to be able to hedge here. If you want to hedge that upside, so this is the 20 delta here. Let's see what it's. Let's see. This is a little skewed a little bit. The price is a little higher on the call side there. So if we did 2, it's going to be about $42 to buy that for 158. Then you can obviously do the butterfly. So it's not going to be too much of a difference. But if you're on the line, if you got an opinion, which type of trade you would do, I'm kind of leaning towards how I would hedge. Anyone have an idea how they would hedge this? All right, so no takers. All right, so I'm gonna hedge this with the call side here, and I'm just gonna do a regular type of just call spread here. I'm just gonna stay simple here. And I'm going to only use $21, and I'm only gonna try to hedge myself by 79 after fees and commissions. So that is what I wanna do. But let's see here. All right, so I just noticed that I didn't send some more capital to this account because it's giving me a day trading pattern rule that I haven't cleared. So I'm gonna have to do that, but I'm trying to keep this account small so that we can see how this is working. So I'm not gonna be able to hedge with this until I add that capital to this account. So with that said, that's not hedged at, and that's keep that position on the way we just did. And it's somewhat of a built-in hedge because you got the iron condor, but we'll see how it plays out. So that's the oil position that I wanted to do today. Looking at any other positions, it's pretty much not too many things I would look to do here, but we have a short oil, we have a put spread on in gold, right? And this is another interesting trade. You got a put spread in, excuse me, a call spread in gold that you can see right here. And if we go over here to silver, we can probably play the opposite game because this is how gold has been looking on this trade. It's been going up like the market. That's why I was trying to indirectly short the market by selling a call spread in gold. If we go to the silver here, this has been going up as well. So what if we kind of hedge it a little bit, and we see silver is actually going up again, but let's see what happens if we get really far away on the silver side, if we can put on a put spread. So we've got 47 days to go into this gold, and let's look at the 47 days with silver here. So click on silver, 47 days, and let's look to the put side and see what type of premium we can get on the put side. So the expected move right here is like 1, let's say it's 2. So let's go to like 17. The 17 is the 2 times the expected move. So that's pretty far away here. That's looking at this 13 delta to go to the 13, and this is kind of big. So I wouldn't go to the 16 or something like that, but let's try the 16.9, see what that looks like. So this is giving me a max loss of 1430, and buying power is insignificant. And this is the max loss here. Excuse me, the max profit. So if I do 2 contracts of this and still under 1,000 potential max loss, and buying power is insignificant. So let's look at that. I like this one as well. So I'm gonna move this up again like we did, just to see if they fill us at a higher price, just testing the grounds there for a second. So they did not, because obviously this is going up. So what we're gonna do is do the puts. We're gonna bring it back down to 14 here, and we're gonna send. And so they did not fill me, but I'm not going to force this one now. I'm just gonna let this play out. So we got a few things working. We have that corn position working. We got the silver position, and then these are victories. These are things we won on that we're just waiting to take off as once they fill us. If one of these get filled, I would cancel the other just to stay small in this account. But you'll be able to see that next time we do a pop-up live trading or some type of event. Next time we do it, I guess we'll have the Monday morning briefing on Monday. All right, so any questions to this point before we conclude this pop-up live trading session?
Brian, it's John.
Hey, John.
Hey, I'm just going back to your oil hedge. I'm just curious. I mean, frankly, I like the idea of just like you were going to do. I like the idea of keeping it simple and just doing a standard hedge with an option on the USO. But what would I'm trying to understand what would be the benefit of the broken wing butterfly as an alternative? How would that? I couldn't follow, all of the upside and downside associated with each.
Yeah,
so
good.
I wonder if you could just kind of compare the.
Yeah, let's do that, John. Great question. So I think we were looking at the 35 days at that point.
August 26th, I think you were looking at, right? No, I'm sorry.
Yeah, so it was 38 days. So I was picking something ahead of it. So let's go to this 35 day here, and you'll see what I mean. So for example, if we do, it's no 30 delta, so I'm not going to go to that 34. I'm going to go to this 28. So I'm going to buy a 1 point wide call spread to hedge the upside, right? So and historically the risk with oil is to the upside because you can have some type of shortage or something like that, right? So the only time it's really been super painful that I can remember to the downside really fast is in recent history, right? That just happened. But if you buy this call spread, this 1 point wide in USO, if you buy one of them, right, the max you can make, and let me just lock this for a second. So you lock this, and the max you can make before fees and commissions is $79, right? That's the max you can make on your hedge before fees and commissions. It's going to cost you $21 to do it. Okay, and that's your max loss. Your max loss is what you pay when you're doing a debit. So this is a debit, everyone. So this is one of the trades we talk about, or hedges we talk about in lesson 8 of course 1, but we also talk about the broken wing butterfly. So keep in mind, one is $79, your max hedge. Okay, your max hedge is $79. So now we're gonna break this down and do a broken wing butterfly. So we buy this 31, and let's sell the 32. And then let's buy the 32 and a half here. And let's turn this into a broken wing butterfly. So you have to sell 2. If I can get this to work right. There we go. All right. So in this scenario, your max you can make is $86 on your hedge. Okay? Max you can make is $86 on your hedge. And this right here it's only going to cost you before fees and commissions $15 because the way this is skewed right now, because it's only a half a point, right? So, but if we change it normally when they don't have a half a point, if we want to go with points, you do something like this, and you can see that this is still going to do something like that. Just turn it off a little bit. Let's do this. All right, so perfect. This is what it normally looks like, right? So you are paying $26 before fees and commissions. That's where you can see this at before I hit this review. And this is your max that can hedge you is 174. And once again, your max loss is what you're paying, is that 126, right? So if it goes and it stays between here, it hits here, this was your max, it hits this 33 and it stops there, that's where it expires, then you're going to get your max hedge of 174. If it stays between here, you're still going to win, right? You're still going to be able to make some money if it stays behind, but you're not gonna get your maxing through there. But even if it shoots all the way past here, right? Even if it shoots all the way past, you're still gonna make more on your hedge than you would on the call spread, because the most you can make on that call spread that we were looking at was $79, I believe, right? So on this one, you will make all the way to here $200. And then if it goes all the way through this one, you will lose $100. So you are still net before fees and commissions 100 of a hedge. So this broken wing butterfly hedges you better overall if it shoots all the way through. Okay. And then obviously if it doesn't, if it stays in this range, you can make more than this 100.
Right. So why would you have chosen to go with the just the simple call spread then as a hedge? So just for simplicity.
So good question. So because you have that embedded short position here, sometimes this takes a second before it reflects how much you are making on it, right? How much is it hedging on it? But you know it's hedging you the way I just mentioned, but sometimes it doesn't reflect that as fast as that put spread. And then I just like to diversify on how I'm hedging, right? Some I want to do, the put spread, or excuse me, the call spread, or the broken wing butterfly, or micro, or all these different type of ways that we try to hedge. So I just think it's cleaner to do it that way sometime.
Okay.
So,
okay.
but
well, that was helpful.
it's not, you can make a strong argument that you can do only broken wing butterflies here. Usually the broken wing butterfly is going to be a tiny bit more expensive, but you can argue that that's the better hedge. I like to diversify how I'm hedging.
It looks like the max loss is only another $5 on this versus the simple call spread, whereas the upside is greater.
It's a little bit more. Correct. Right? Correct. So if I go back to that call spread here, this is going to be, I had to take that off, take one of those off. All right, so yeah, so this is $21 before fees and commissions. So, and it hedges you up to $79 right there, right? So if we go back and do this again, so that's $21. And excuse me, I didn't mean to make them both. Let's highlight that, make that a long again, then buy this. All right, so like you said, it was $5 more.
Yeah. But
so you can
special profit.
Yeah, you can say that that's insignificant, right? Because you can almost double how much it hedges you based on if you pay $5 more, if you can get filled on that, right? So
right. Interesting. Okay.
Okay. Yes.
Now the one other possibility you mentioned was just buying a share of USO, but correct me if I'm wrong, but I think since USO is a partnership, if you buy and sell that one share, you're going to get a K1 on that, right? Which is kind of a pain in the neck.
So partnerships get a K1, but I don't know if that works that way, and that's an excellent question. I don't know if it works way for ETF in the market, right? So I don't know if it's some differentiator between being a partner in a regular type of partnership, right?
Yeah, unfortunately, I mean, I've owned USO before, and unfortunately, you do get a K1, which is
okay. You do get okay. All right. Yeah. Then yeah. So then you would have to wait a little longer, perhaps, so they can send you that K1 and all that kind of stuff. I obviously run a few businesses that are a partnership or a LLC that is taxed like a partnership. So
sure.
I don't have a problem with K1s, but
So you're used to dealing with them at tax time.
Exactly.
Okay.
But you just educated me on this because to be honest, I didn't start trading stocks, stock options or stock until the market went down for quite some time, right? Because I started with buying stocks and started with stock options when I started with options and so forth. But I've been a guy that has played in the futures options world for some time since I started my fund in 2013. So, but I do think it's fun, and like I always tell people, it's fun with stocks. It's a little bit more, it's a lot more things you can look at and so forth. And it seemed like a great time to kind of give my philosophy on how I would trade options on stock recently. So, but as you know, I've been hedging with these ETFs for quite some time. So that's the only thing. I mean, I try to use these only to hedge, but I haven't received any K1, and if I did, maybe I missed it. But I trust you on it. If you've been buying stock in it, maybe options. Obviously, I haven't been buying stock, so options are different. You don't have to worry about getting a K1 then, correct?
Sure. Yes. Yeah. Understood.
Okay. Awesome. So thank you.
That was a helpful comparison. Thank you very much.
You are very welcome, John. So any other questions before we conclude this pop-up session? That was a great one. I did explain that in the past, John, but you probably was not on the call when I did that. So that one is that's important to understand the differences and so forth. And I believe I pointed out in lesson 8. If I don't, it's in the document that's talking about it. But it's definitely a good strategy to consider. You can decide which one you want to do from time to time. Once again I kind of switch off on them. All right, so if we don't have any other questions, we will conclude this pop-up live session now. But the last thing I want to say is that, once again, if one of these get filled, I will cancel the other. And I'm talking about these two trades that we were doing here. Okay. And the reason why I'm not doing something in the indexes is because we already have something in indexes, and I'm trying to do stuff that's not correlated with the indexes, or something that's indirectly correlated when I'm talking about shorting or going long and so forth. So in that, if I get filled on this silver, it's almost like doing a pairs trade, right? You're buying one product that is very similar to another, and you're selling that other one. So you're kind of doing a pairs trade. And I kind of introduced pairs trading in course 3, but this is kind of a simple way of showing you what a pairs trade is like, right? So let's say you had two companies that did the same thing, right? You had Adidas and you have Nike, right? So you buy Nike, you sell Adidas, or something like that, for example. And so this silver and gold is a perfect example. You buy gold, you sell silver, or vice versa. That is a pairs trade in its simplest form. All right, so everyone, try to have a great rest of your day and a great weekend. I will check in everyone at the end to see how you finish up the week, and hopefully strong. But we are having another up day. The Nasdaq will not go down, but when it does, unfortunately, it's probably going to be a really big down day, like 5% or something. I wouldn't be surprised if the Nasdaq went down 1,000, 1,500 points. But with that said, obviously not in a day. With that said, have a great rest of your day. Talk soon.
Thank you.
Thanks, O'Brien.
You're welcome. Thank you.